Good morning, people. What's going on? Welcome back to another YouTube video. So a lot of you guys have been asking if I can make a video about futures risk management. Today, we're going to break it all down from the contract size to the tick value to how to work out points, absolutely everything. Because remember, if you guys are moving into futures, amazing. I'm super excited for you guys to be making the move, and I want to make it as easy for you to understand as possible. So I'm going to keep this video super simple, super to the point, because you guys have to understand the importance of contract sizes depending on the instrument that you may be trading. If you trade 10 contracts on gold and then you go trade 10 contracts on oil, you're gonna find yourself in some very tricky waters. So you have to be understanding the difference and the position sizing that you should be following based on the value of tick moves. So throughout this video, I'm going to give you guys an example of what I predominantly trade, which is gold. However, I'm also going to be breaking down the tick value of these other instruments that you guys can see here. So on this table, we have gold, we have the NASDAQ, we've got the S&P, we have the Dow, we have the Russell, and we have crude oil. You guys have to understand that ticks and points are two very different things. This is the size of a tick and the tick value. So each 0.1 tick move on gold is worth $10. On the NASDAQ, it moves in increments of 0.25, and each of them is $5. And then for the S&P, $12.50. So as you guys can already see, the tick size of the NASDAQ and the S&P is the same, but the tick value is actually a lot more. And if you don't understand that, then you're going to come into some difficult risk management places where you find yourself either overexposed or potentially underexposed. So each tick that the NASDAQ moves, that's either $5 in profit or $5 in negative. Each tick that the S&P moves, that's either $12.50 in profit or $12.50 in the negative. And then for gold, 10. And then you guys can see here, the Dow is actually a point move. So every point move the Dow moves is $5. The Russell, every 0.1 tick move is $5. And then for crude oil, it's 0.01 is $10. So each 0.01 tick that crude oil moves, that's $10. So if you compare that to gold, the tick value is the same, but on gold, the tick size is a lot bigger. So understanding these is very important. Just use the example of the NASDAQ. So in order for the NASDAQ to move 1 point, you would times 0.25 by 4, and that would give you 1 point. So you would do $5 times 4, which is 20. Each point that the NASDAQ moves, that's $20. So in ticks, it's 5. In points, it's 20. If we take a look at the point value chart, just so you guys can get more of a visual understanding, because the points that the instrument will move are very, very different. So if you're tracking how much an instrument has moved in points per day, then each point value is going to be very different. So for gold, you have the tick size is 0.1. So you would times that by 10 to give you 1 point. So you do the tick value, $10 times 10 equals 100. Each point that gold moves is $100 per contract. If you trade 1 contract, $100, 10 contracts, $1,000. And then you guys can see here, so for the NASDAQ, I know a lot of you guys trade the NASDAQ, each tick size is 0.25. So to make up 1 point, we would have to times that by 4. 0.25 times by 4 is 1 point. $5 times by 4 is 20. So each point that the NASDAQ moves is $20. The tick size on the S&P is the same, but the value is a lot bigger. So 0.25 times by 4, 1 point. $12.50 times by 4, $50. So each point that the S&P moves is going to be $50. Each point that the NASDAQ moves is only going to be 20. So if you trade same position size trying to catch the same amount of points, you're going to be either overexposing yourself and you're going to come in some tricky situations which you guys don't want to do. Now, I want to draw your guys' attention to probably the most outstanding one here, which is crude oil. So crude oil moves in instruments of a 0.01 ticks, which is $10. So in order to work out the point value, we're going to do 0.01 times by 100 to give us 1 point. The tick value being $10, $10 times 100 is 1,000. So each point that crude oil moves is going to be $1,000 increments per contract that you trade. So as you guys can see, if you start trading the same contract size that you do on gold as you do on oil, and they both move 10 points in or against you, the dollar amount is going to be very, very different. Now I'm going to give you guys a real example of how to measure the move on gold. So gold on Friday had an incredible move off NFP, and gold bounced from the lows to the highs from 1954.5 all the way up to 1984.2. Now, how do we work out what that is in terms of a dollar amount? So we want to work out the total point moves of that. So we want to understand the figure from 1954.5 to 1984.2, and that is a total increase of 29.7 points. Now, how do we then work out the tick value? We already know from previously that the tick size is 0.1. So if we do 29.7 times 0.1, that's going to give us 297 ticks. So this entire move up from 1954.5 to 1984.2 was 297 ticks. And then in terms of working that out into the dollar amount, well, we already know that the tick value of gold is $10. So 297 times 10 gives us $2,970 per contract that you trade now. And remember, this goes the same in profit as, again, if you're buying gold at 294.5 and you had short, you go into a loss of 297 ticks, you are minus 2,970 on the day. So it works both ways, and this is why it's important for you guys to understand the value of each tick move of the instrument that you are trading. I'll give you guys another example on the S&P. So on Friday, again, the S&P dropped from 4,560.75 all the way down to 4,493.75. So again, a huge move. Now this total move, so if you take 4,560.75, take away 4,493.75, that's going to give you 67. So that's a 67 point move in the S&P on Friday. Now, in terms of working that out into ticks, well, we know we need 4 ticks to make 1 point. So we take 67 times by 4 is going to give us 268 ticks. And each tick move on the S&P is $12.5. So if you do 268 times $12.5, that's going to give you a total of $3,350 per contract on this short on the S&P, and vice versa. If it was to go against you, you would have lost $3,350. So it's important to understand that, my God, yeah, these figures sound great, but the likelihood of you shorting that from the top and closing the bottom is unlikely. This is just to give you guys the perspective of how you can actually measure the move and relate it to a dollar amount. So now I'm going to show you guys some of the trades that we took during June and July to give you guys a visual representation of what that may look like. Now, for you guys who are new to the channel, I go live in the community every single day in the London session where we day trade gold futures live. You can watch me take the positions, the management, the stop loss, the take profit, everything in the community Monday to Friday in the London session. So in July, we actually had a very good month in July with our biggest loss being 15 ticks. So 15 ticks, in a dollar amount for me is 1,500. So when you guys have seen me for free on YouTube day trade gold, I'm typically trading 10 contracts on my Top Step account. Now you guys click the link, you can go check out what Top Step is, but they can basically give you funding so you can trade futures without risking your own capital. So if we take a look, let's just take a look at one of these positions. So on this play here, I took a total of 37 ticks out of gold in this trade. This was a lovely quick momentum scalp, breaking the highs, playing up for a lovely run. I broke down this video as well. You guys can go check out that gold recap. And that position hit 37 ticks. So I traded that with 10 contracts, and that was a $3,700 trade. If you guys trade 1 contract, that was an amazing $370 push in that very, very small move. If we look up at the total for the month, we ended the month up 137 ticks. Now, if we relate that to some sort of dollar amount, if you guys trade 1 contract, that's 1,370. If you guys trade 10 contracts, that's $13,700 for the month. The biggest loss being 15 ticks. Now we'll take a look at June. These are all the trades that we took, the times on stream. The biggest loss we took in June was 7 ticks. So we were minus $700 on that position. You guys trade 1 contract, that's 70. But for me, I'm trading 10. So my biggest loss for the month of June was $700, which is amazing considering our average TP is around 15 to 20 ticks. So our biggest play in June was a 30 tick move here. If we take a look at the trading view chart, we can see that was a lovely bounce off that support, breaking it back up into that liquidity. So 30 ticks for me, 10 contracts, $3,000. For anyone else trading 1 contract, $300. And we ended the month in June up 134.5 ticks. So dollar amount for that per contract is 1,345, 10 contracts, 13,450. So June, again, incredible month. Great to see the relatability of the tick move to the dollar amount for when you guys are trading futures. Now, this is predominantly just gold statistics. It'll be different for when you guys trade NASDAQ, S&P, Russell, oil, whatever it may be. But you guys now have the foundations to be able to really understand the true tick value points and working that into a dollar perspective amount. And remember, I live stream on YouTube for absolutely free as well in the Asian session and the London session every Tuesday to Friday. If you guys have any questions, leave a comment below. Check out the other videos and I'll see you on stream or in another video. Peace.